Hey there, fellow finance enthusiasts. Today, we're diving into a topic that's both fascinating and crucial for any registered investment advisor, RIA, looking to merge or acquire: the valuation gap in RIA M&A. Now, you might be wondering, what's this gap all about and why should you care? Well, let me tell you, it's a game changer, and understanding it could be the key to unlocking massive value for your firm. So buckle up, because we're about to explore the ins and outs of this dynamic market and uncover some valuable insights along the way. First things first, let's talk about the two sides of this split screen. On one side, we have the sellers, who are optimistic about M&A volume and firm valuations. According to DeVoe & Company's 2025 annual outlook, 54% of RIA leaders expect M&A activity to pick up, and 59% believe valuations will remain steady or rise. Now, these numbers aren't surprising, considering the 17.8% compound annual growth rate in wealth management merger deals since 2020. But here's the catch: on the other side of the screen, we have the buyers, who are a bit more cautious. In a recent DeVoe survey, 82% of RIA executives anticipate stable valuations, while only 18% expect declines. This gap between sellers' expectations and buyers' willingness to pay is the real deal, and it's what's going to shape the market in the coming years. Now, let's dive into the numbers and see what this valuation gap looks like in reality. In 2026, RIA business valuation multiples range from 5x EBITDA for sub-$500 million AUM lifestyle practices to 13x, 15x EBITDA for billion-dollar fee-only firms with documented organic growth and second-generation advisor benches. The median valuation in 2025 hit a record high of 11.6x adjusted EBITDA, up from previous years. But here's the twist: buyers aren't paying the same multiple for every firm. The spread between a 5x deal and a 15x deal is enormous, and it's not random. So what's the variable that separates these firms? It's not the AUM, it's the quality of the growth behind that AUM. Now, let's talk about the three growth models that RIA firms use to grow organically. First up, we have referral-driven growth, which is the industry default. COI relationships, client referrals, and professional networks are important, but they're also opaque. When your top referral source retires, the pipeline retires with them. You can't show a buyer a model, forecast it, or replicate it in a new market. But here's the thing: sophisticated buyers are getting better at identifying which firm's growth will survive ownership transfer. Referral books are increasingly viewed as a relationship risk, not a growth asset. Next, we have lead broker growth, which is essentially rented growth. Platforms like Smart Asset and Zoe give advisors access to high-intent leads, but it comes at a cost. Lead brokers acquire that traffic for around $55 to $75 per lead, then sell it back to advisors at $300 to $500 per lead. And guess what? They sell it to 5 competitors too. So you're paying a 5 to 10x markup for a lead that your competitor just received. And when you stop paying, the leads stop coming. You own nothing, and you've learned nothing. The signal intelligence stays with the broker. Finally, we have systematized organic growth, which is the model that commands premium multiples. It's not because it's more expensive to build, but because it produces something a buyer can underwrite: documented CPL that the firm owns and controls, audience data that compounds month over month, a growth system that improves with every campaign signal, and a marketing infrastructure that transfers with the firm, not back to a vendor. RIAs with 3-year organic growth above 10%, net of market, tend to trade at a premium of roughly 1.0x to 1.5x to adjusted EBITDA relative to peers with organic growth below 3%. That's a huge difference in enterprise value, and it's all about the growth system behind the numbers. Now, here's the thing: the valuation premium is measurable. My brother, Jeremiah Carnell, spent his career at the intersection of advisor practice management and enterprise data. As CEO of Trualytics, he had access to granular KPI data across thousands of RIA and enterprise advisory clients. The pattern was consistent: firms that had systematized their client acquisition showed dramatically better performance metrics. Lower client concentration risk, predictable revenue growth curves, and documented CAC and client lifetime value data that a buyer could actually underwrite. The Trualytics data made this concrete. Firms with systematized, scalable, predictable organic growth commanded valuations approximately 200% higher than comparable firms that hadn't built that infrastructure. So, what does this mean for you? Well, if you're considering a transaction in the next 2 to 5 years, the single highest leverage investment you can make today is not in headcount, technology for your advisors, or another COI dinner. It's in documenting and systematizing your client acquisition. Buyers are predicting a valuation flatline, and they're right for most firms. But the firms with owned, data-backed, systematized growth engines are going to find that buyers still compete aggressively for them because they're increasingly rare. The spread between a 5x deal and a 13x deal is a growth system, and building it is the work of the third quarter. In conclusion, the valuation gap in RIA M&A is a real deal, and it's going to shape the market in the coming years. The firms that understand why the gap exists and have a documented, systematized growth engine will be the ones that escape it. So, if you're an RIA owner considering a transaction, now is the time to start building that growth system. The window is open, and the leverage is real. Thanks for joining me on this journey through the world of RIA M&A. Until next time, keep thinking big and growing smarter.